It's a Tuesday. You check your balance on your phone, standing in line for coffee, screen tilted away from the person behind you. Payday was Friday. It's Tuesday. Rent cleared? The car insurance cleared. There's a charge for $11.99 you don't recognize and won't cancel because canceling it means logging into something. The number on the screen is real and it's yours. And it is smaller than it was 96 hours ago.
You do the arithmetic you've done 1,000 times. Days remaining, dollars remaining. You put the phone face down.
Now, hold that number in your head. In June 2021, ProPublica published a set of leaked Internal Revenue Service records covering the 25 wealthiest Americans. Between 2014 and 2018, their combined net worth grew by $401 billion. They paid $13.6 billion in federal income tax over that same stretch. That's a true tax rate of 3.4%.
In that same period, the Federal Reserve's survey of household economics and decision-making found that roughly 1 in 3 American adults could not cover an unexpected $400 expense with cash on hand.
2 Americans, 2 arithmetics. Same currency, same IRS, same country.
And the gap between them is not what you were told it was. What follows isn't a story about discipline, and it isn't about skipping the coffee you're standing in line for right now. It's about a simple fact. Wealth and poverty produce measurably different brains, and those brains run on 2 different tax codes. Once you see how the 2 systems interlock, you won't read a headline about money the same way again. Start with the brain, because that's where the myth lives. In August 2013, the journal Science published a study by Anandi Mani, Sendhil Mullainathan, Eldar Shafir, and Jiaying Zhao titled Poverty Impedes Cognitive Function. The design was simple to the point of being uncomfortable.
The researchers set up in a shopping mall in New Jersey. They stopped ordinary shoppers and gave them a hypothetical. Your car needs repairs. Then they ran standard cognitive tests, the kind of fluid intelligence and executive function measures used in IQ research. For half the participants, the repair cost $150. For the other half, $1,500. At $150, rich shoppers and poor shoppers scored the same. No gap, none. At $1,500, the poorer participants' scores collapsed. Same people, same tests. The only variable was the size of a hypothetical number they had been asked to hold in their heads. Mullainathan and Shafir then took the experiment to sugarcane farmers in Tamil Nadu, India, who receive most of their annual income in a single lump sum at harvest. They tested the same farmers twice, once before harvest, when money was scarce, and once after, when it wasn't.
The post-harvest scores were higher by the equivalent of roughly 13 IQ points. Not different farmers, the same farmers, a few months apart. The variable was not education or intelligence or motivation or character. The variable was how much money was in the house. 13 points is not a rounding error. It's a meaningful fraction of a standard deviation. Mullainathan and Shafir compared the effect to losing a full night of sleep, then noted the obvious, brutal implication. Financial scarcity taxes the exact cognitive machinery you'd need to escape it. They named the mechanism bandwidth. Attention is finite. Every dollar you have to actively manage consumes some of it. When your margin for error is 0, the management never stops. Which day the deposit lands, which bill can float, which card has room. The mental process you run in a coffee line on a Tuesday isn't a personal failing. It's a background program that never terminates, running on hardware that has no spare cycles.
Wealth, in this framework, buys something more valuable than objects. It buys the right to not think about it. But bandwidth is only the first layer. Even if you handed every household in America identical cognitive slack tomorrow morning, the 2 Americas would still diverge for reasons written down in plain English in the United States tax code. Open the tax code to the difference between the words income and gain. Everything follows from there. If you earn a wage, the IRS takes its share on the day you earn it. Your employer withholds it before the money touches your account, a system introduced by the Current Tax Payment Act of 1943, sold to the public as a wartime measure and never repealed. For 2025, the top marginal rate on ordinary income is 37%. On top of that comes 6.2% for Social Security and 1.45% for Medicare, matched by your employer. If you own an asset that goes up in value, the IRS takes nothing. Not a reduced amount, nothing. Under Eisner versus McComber, decided by the Supreme Court in 1920, gain is not taxable until it is realized, until you sell. So the wealthy don't sell. The strategy has a name in estate planning circles. Buy, borrow, die. You buy assets, you hold them. When you need cash, you don't liquidate. You borrow against the portfolio at rates that, through the 2010s, ran a few points above the federal funds rate. Loan proceeds are not income. There is no line for them on Form 1040. In 2012, Larry Ellison, then chairman of Oracle, had pledged roughly $10 billion of his own stock as collateral for a personal line of credit. Elon Musk pledged tens of millions of Tesla shares. Neither transaction generated a taxable event because borrowing money has never been earning money. Then comes the third step, and it is the one most people have never heard of.
Internal Revenue Code, Section 1014, the step up in basis. When you die, the cost basis of your assets resets to their market value on the date of death. A share bought in 1985 for $3 and worth $900 in 2025 passes to your heirs as though they had purchased it that morning for $900. The $897 of gain, the entire lifetime appreciation, is never taxed. Not by you, not by them, ever. The Joint Committee on Taxation has estimated the step-up costs the Treasury well over $100 billion across a 10-year window. President Biden proposed narrowing it in 2021. It survived. So the loop closes. Buy the asset, borrow against it instead of selling, die, and the tax liability dies with you. Your heirs inherit the shares, sell them at the stepped-up basis, and pay off the loan. That is how a person can move $100 million through a lifetime and produce a true tax rate of 3.4%. Not through fraud, not through offshore accounts, but through three provisions that are entirely public and entirely legal.
Now put your paycheck next to it. Your Social Security tax applies to the first $176,100 of wages in 2025. Above that ceiling, the rate drops to zero. A person earning $80,000 pays 6.2% on every dollar. A person earning $8 million pays 6.2% on about 2% of theirs. The tax that funds the retirement of 68 million Americans is structurally regressive by design and has been since the Social Security Act of 1935 set its first cap at $3,000. And the wage itself has stopped doing what it used to. Bureau of Labor Statistics data compiled by the Economic Policy Institute shows productivity rising roughly 80% between 1979 and 2019, while typical worker compensation rose about 17%. The output grew, the paycheck didn't. The difference went somewhere, to profits, to equity, to the asset column, which means the two Americas aren't just taxed differently, they're paid in two different currencies. One is taxed on arrival and spent on survival. The other is untaxed until sold and never sold.
That's the machine. But it doesn't explain the strangest part of all this, which is what happens inside the mind of someone who already has the money. In 2012, Paul Piff, then a doctoral researcher at the University of California, Berkeley, rigged a game of Monopoly. The rules were fixed in advance. One player got twice the starting cash, collected twice the salary passing go, and rolled 2 dice instead of 1. The other player knew all of this. A coin flip in front of them decided who got which seat. 15 minutes in, the advantaged players were moving their pieces louder, banging them across the board. They ate more pretzels from the bowl on the table. Piff's team recorded the shift on video. Then he asked the winners why they had won. They talked about strategy, property acquisition, timing. Almost none of them led with the dice.
Piff published the broader work in the Proceedings of the National Academy of Sciences. Across 7 studies, higher social class predicted more unethical behavior, cutting off pedestrians in crosswalks, taking candy designated for children, misreporting outcomes for a prize. The finding is not that wealthy people are bad. It's narrower and stranger than that. Advantage rewrites the story a person tells about advantage. The dice become skill in memory. But there's a second finding that complicates the first. In 2010, Daniel Kahneman and Angus Deaton, both Nobel laureates, both at Princeton, analyzed 450,000 responses from the Gallup Healthways survey. They found that day-to-day emotional well-being rose with income and then flattened out around $75,000 a year. Above that, more money bought life satisfaction on paper,
but not much felt experience. The number went viral. It also turned out to be incomplete. In 2021, Matthew Killingsworth at Wharton ran the study again with real-time smartphone sampling. This time, there was no plateau. Happiness kept climbing with income. Rather than fight, Killingsworth and Kahneman ran an adversarial collaboration together and published the resolution in 2023. Both were right. For most people, well-being keeps rising with income. For an unhappy minority, roughly the bottom fifth in emotional terms, the curve flattens hard because their suffering isn't financial and money can't reach it. Which brings up Michael Norton's finding at Harvard Business School. He surveyed people with net worths above $1 million, some above $8 million, and asked a single question: how much would you need to be perfectly happy? Almost everyone answered with a multiple of what they already had. 2 times, 3 times. The person with $1 million needed $2 million. The person with $10 million needed $30 million. The finish line moves. It always moves. That is not a character flaw among the rich. It is the standard behavior of human reference points, first described by Kahneman and Amos Tversky in their 1979 paper on prospect theory. We do not evaluate wealth. We evaluate change in wealth from wherever we happen to be standing. So here is what the whole picture actually shows. The 2022 survey of consumer finances found the median American family's net worth was $192,900, and most of it sat in one house. The top 10% of households owned roughly 87% of all corporate equity. The two groups aren't holding different amounts of the same thing. They're holding different things entirely. One, an asset you live inside and cannot spend. The other, an asset that compounds while you sleep and isn't taxed until you sell.
Every mindset difference you've ever read about maps onto that split. Long time horizons are what you get when your rent is not due. Risk tolerance is what you get when a bad year is a bad year and not an eviction. Thinking in decades instead of days is a luxury purchased with margin, not summoned with willpower. The farmers in Tamil Nadu gained 13 points of measured cognition without changing a single belief about money. Their harvest came in. So the question was never how rich people think. It's that thinking is downstream of the seat you were dealt. And the seat, in this country, was assigned by the Current Tax Payment Act, by Section 1014, by a $176,100 payroll ceiling, and by whether the dollars in your life arrive as wages or as gains. You're not standing in that coffee line running the wrong mental program. You're running the correct program for the position you're in. That's the part that should unsettle you.
Thank you for watching. See you in the next video.